when sideways markets are actually a buy signal. Master the 3-3-5 structure and trade the powerful continuation.
At first glance, financial markets look like pure chaos. But beneath the daily noise of erratic price ticks and sudden drops, prices move in a predictable, repeating geometric rhythm. This chart outlines the core principle of Elliott Wave theory. Notice how the strong upward trend on the left unfolds in 5 distinct steps, an impulsive sequence. Once that push exhausts itself, the market pulls back in a 3-part sequence called a correction. Financial assets spend roughly 80% of their lifespan trapped right here, in these corrective, non-trending states. Because these pullbacks can be violent and drawn out, amateur traders often misinterpret a healthy pause as a total collapse, selling out of their positions right before the trend resumes. Look at the sharp V shape on this chart. This is a zigzag, the aggressive, highly visible sell-off that most traders expect a correction to look like. Markets rarely make things that obvious. Often, an asset will simply grind sideways in a choppy, directionless box for weeks or even months. This endless meandering wears down a trader's psychology. The lack of momentum causes frustration, leading many to assume the underlying trend has ended. They close their trades in pure boredom. The primary trend remains intact. This sideways grind shifts the correction from price to time, following the specific rules of the flat correction. If we zoom inside this sideways chop, we find a precise internal mechanism, a mathematical gear known as the 3-3-5 wave sequence. It begins with wave A. This initial move against the primary trend subdivides into 3 smaller waves, failing to gain any real downward momentum. Then comes wave B. According to the rules of the pattern, this reaction must also be a 3-wave move, and it has to retrace more than 61.8% of the distance covered by wave A. Finally, the structure flushes out the remaining weak hands with wave C. This is a decisive 5-wave drop that must cover at least 38.2% of wave B's territory, frequently exhibiting a drop-off in momentum by the time it reaches the bottom. This sequence provides a mathematical framework for the market to stabilize momentum before the trend continues. In strong trends, a specific variation called the expanded flat emerges, pushing price boundaries in a way that triggers reactive crowd behavior. This chart shows the effect. The middle sequence, wave B, pushes so high that it pierces the peak of the primary trend. Amateur traders see this new high, assume a rally is starting, and buy into a false breakout. The moment they buy, the market snaps back. The final wave C reverses, slicing below the previous low of wave A. The traders who bought the highs often panic sell the absolute bottom. Once this double fakeout has cleared out retail traders on both sides, the market launches into a vertical impulse wave, resuming the true trend. The expanded flat operates as a liquidity trap, using these structural extremes to shake out impatient capital right before the real move begins. Professional Elliott Wave traders do not guess where these consolidations will end. They map them using precise Fibonacci extensions to calculate where the pattern will exhaust itself. Misidentifying the structure by ignoring the internal subwave counts is a common error. Trading without verifying the correct 3-3-5 sequence often leads to premature entries. Securing a position requires waiting for the definitive 5-wave substructure of wave C to completely print on the chart before deploying capital. By aligning the final completion of wave C with a Fibonacci retracement zone from the larger trend, you create a calculated high-probability trigger to enter the market. Sideways markets provide essential data for those who understand their structure. By recognizing the 3-3-5 flat, you can navigate the pause, avoid the psychological traps that wipe out the majority, and position yourself for the impulse wave that follows.